We're talking to Richard Yetsenga. He's a managing director at HSBC and also Asian Forex strategist at the bank. Good Thursday morning to you. Let's get some reaction on these numbers. Looking at the headline figure, 10.7% GDP growth in the quarter, slightly faster than what economists had expected. How are you seeing this number? How do you see the Chinese economy right now?
I think, unfortunately, a year ago we were worried about China being too weak and the world economy being too soft, and now, in a way, strong news is bad news. So the question for today's numbers really was, are they strong enough that the markets generally get more fearful about further tightening? And I think, some of the numbers are in line with expectations. 10.7 for GDP, though, is probably a little stronger than people were looking for. It's not a blow-off kind of number, but I think it's enough to keep people very nervous about more policy action in China. And certainly, one of the features of markets yesterday was the fact that it seemed like everybody in China who had a view about something was expressing it, gave us a lot of volatility in markets. And I think data like this is probably going to keep markets sensitive to that sort of news.
Yeah, what about the risk of inflation? Looking at these price numbers, price index figures, all three of them coming in way above expectations. I guess that does signal that tightening should be coming sometime down the
policy
pipeline.
Clearly needs to slow things down a little bit, and depending on your view, I suppose people have different levels of urgency about that. But I think clearly the news flow over the next few months in China is going to be about tightening, and markets will be continually trying to trade off this strong versus weak expectation. As I say, I think today's numbers are strong enough that markets are going to stay nervous about this for the near term. Yeah,
earlier, Richard, I was talking to another economist who said he's expecting interest rate hikes next month, Q2, Q3. What sort of tightening are you expecting from the Chinese authorities?
We're much more modest than that, in fact. I mean, our core view really is that, yes, there's some inflation coming through in the numbers now, but a lot of this is one-off commodity price stuff related to seasonal factors, cold weather. We're coming off low bases also in the year-over-year numbers, which will tend to boost things a little bit, and after a couple of months of higher numbers will plateau off. So maybe you get some more tightening in the near term, but if we do, it's probably going to continue to be in the form of reserve requirement hikes, moral suasion over the banks. The problem with an interest rate hike, of course, is when you're trying to keep your currency under some form of control, with US rates still at zero, that probably makes that job more difficult. So I don't think you get any rate hikes probably till the middle or the second half of the year.
Okay, but what about the credit growth? We've been hearing from the Chinese authorities they want to slow down lending, but the latest indications that we're getting is that Chinese loans may have exceeded 1.1 trillion yuan just in the first 2 weeks of January.
Which is a problem, of course. In fact, if we're thinking about something like 7 trillion for the entire year, 1 trillion in the month of January probably would be okay. But in the first half, as you say, very, very strong.
Very strong.
Hence, again, the market sensitivity to any commentary out of China about restricting credit growth, putting credit limits on banks, raising reserve requirements for specific banks. Again, the markets are going to stay nervous about this because of the strength of the numbers.
Yeah, quickly, since we have a minute before we get to break here, Richard, what about the yuan? I mean, do they have to let loose this currency maybe sooner than expected?
Well, I think people have been expecting it for a while already. The problem, if you have an environment of excessive credit growth and you add an appreciating currency to that, it's hard to see how that helps the situation. The extent it attracts more hot money into China, it probably makes it worse. So I don't think you're going to see anything meaningful on the yuan till the middle of the year, maybe even after that.